Hi everyone, this is Nusrat again. I'm going to present today the Chinese family farm as a multinational enterprise. The paper was prepared by Daniel M. Shapiro, Eric, and Caroline Edener. And the presentation is going to be a bit long because the paper has 14 propositions and a little bit of explanation is really needed to better understand the propositions. So let's start with the introduction.
Chinese have their footprint in business not only in their home countries but approximately 60 million overseas Chinese residents, primarily in Southeast Asia, have built a vast interconnected system of highly successful business. One of the central attributes of this Chinese business is the persistence of family control. Even it's applicable for the largest companies. And in last few decades, it has been widely recognized that overseas Chinese family firms represents both a distinct and economically significant organizational form. They comprises only 6% of the population of Southeast Asia, and but they control more than 70% of the region's corporate wealth. When it comes to a FDI, foreign direct investments in China has also increased, and they are now the second largest host market for international investors. A number of recent studies indicate that business controlled by overseas Chinese families provide the majority of FDI in China. The Chinese farm business group operate networks of business across East and Southeast Asia and in other parts of the world as well. Despite their scale and international scope, these enterprises remain family business, and they are typically controlled and managed by the number of family members and trusted business associates. Though most of the existing literature on the Chinese family firms suggests that it is a unique business institution that reflects Confucian values as well as the institutional structure and traditional pattern of authority. In contrast, some of the other studies have examined the strategic behavior of Chinese family firm from an economic perspective. In this paper, the authors have addressed the gap in literature by applying the Dunning's electric theory of multinational enterprise to the Chinese family firm. And they found out that Chinese family firms differ from Western family firms regarding their strategic behavior and distinctive competencies. Major objective of this paper thus is to explain how these characteristics features of the Chinese family firm provide a basis for gaining competitive advantage through international expansion within the parameter of the electric theory of the M&A. Let's briefly discuss about the methodology of analyzing M&E. And authors have adopted Dunning electric theory because it represents the most general and widely used framework for analyzing the M&As. The theory is designed to explain why a firm from one country engages in value-added activities outside their national boundaries. Dunning himself described it as a paradigm. The paradigm suggests that there are three general factors. In this case, we can call it parent of the study that that governs the propensity of a firm to engage in internationalization production, the ownership advantage, location advantage, and internalization advantage. It is the configuration of ownership, location, and internalization advantage facing in a particular firm that determines the capacity to produce in abroad. Let's first talk about the ownership advantage. Ownership advantage refers to the possession of firm's specific assets that provide the firm with a competitive advantage at home and abroad. Ownership advantage arises from the resources and capabilities of the firm that are in fact comparable to its core competencies. The resource and competencies of the firm are comprises of its income generating assets, most particularly those that cannot be easily imitated because they are to some degree proprietary. Proprietary asset can be tangible such as capital equipment or intangible such as technology, patent or trademark. The company's proprietary asset also include capabilities such as human resources required to design and market successful new products, or the ability to more effectively manage and organize the production of existing products. The possession of such proprietary asset is closely related to the product differentiation, and also it is necessary condition for internalization, national product to occur. And there are some studies that find a positive relation between farm size and overseas production activity. The conventional argument is that since foreign investment occurs high fixed costs and relatively high risks, large firms are able to make large investments, or the large size is associated with a variety of strategic advantages according to large firm, which may give rise to economic of scale or scope at the firm level. In a related manner, it has been found that firms with an existing international network achieve network economic that permit further expansion. Second one is location-specific advantage. This analysis suggests that M&E is a firm possessing ownership advantage in its domestic market. Given that the firm has the capacity to produce abroad, what are the factors that can affect it to actually produce in the abroad, not in their home countries, right? The location-specific advantage have is a term and comprises variables as production and transportation cost, resource endowment, the size of the market and markets, infrastructure, government incentives, regulations, and cultural and political differences. The fact is that the GDP of both source and host countries are importantly such that there has to be some sense of match between economic, strategic, and cultural characteristics of the investors and participants to be successful. So experience in a certain specific region or country can reduce the investment risk and also allow for cost reduction through learning. The third and final one, the internalization advantage. The fundamental characteristics of the M&E is that it engages in overseas production through communication governance, like ownership one, rather than through market transaction, such as the sale of proprietary assets to or the right to their use. The advantage that permits firm to transfer their ownership advantage approach in this way are termed as internalization advantage, because they attempt to explain why firm internalize foreign products rather than they rely on the market exchange. Internalization tracks out some or all of the two outside firms. This phase of the argument relies heavily on transactional cost economics. The transactional cost approach suggests that market imperfections create costs that in turn make internalization a more attractive option. Transaction costs associated with market exchange enhances the advantage of hierarchical control. There are several reasons market exchange is costly and risky related to hierarchical control. So the M&E emerges as a firm that chooses to transfer its proprietary assets abroad by establishing a common ownership and governance of production facility abroad. Um, if we summarize this, we can find that this paradigm suggests that most M&E emerges from the application of abroad of proprietary emerges from the application abroad of proprietary asset developed at current home, although some FDI may result from the need of acquire resource and the capability not available at home. These assets are the most important part related to technology or product differentiation and the transactional costs associated with their transfer abroad determine the mode by which this is accomplished. choice of the country to which the assets are transferred depends on a variety of locational consideration, including the cultural proximity.
So far with our discussion, we understand that a significant number of Chinese family firms are multinational enterprises. Now in this section, we are going to discuss about Chinese family firm as a M&E and as the topic of this study suggests. And for that, authors I have used Dunning's elliptic paradigm as an organizing tools to systematically analyze the Chinese family firms and also to compare it with American and European M&Es. They have derived a lot of set of propositions, which is informed by both the theory of M&E and the extant literature on the strategic behavior of Chinese family firms. They have proceeded in the paper like by considering the sequence of ownership, location, and internalization advantage that most closely characterize the Chinese family firms and also that makes it different from other M&Es. In this paper, seven proposition has been discussed in relation to ownership specific advantage of the Chinese family firms. To discuss seven of them, let's start with the background of the first three, uh, where the differences between the classical M&E and the Chinese family firms has been discussed in respect to their strength and also the strategies they follow. The European and American M&E that we call classical M&E is has a competitive advantage normally and a monopoly that they acquire at their home countries and then they start exploring the abroad. As we discuss in the ownership specific advantages, it's typically based on the proposition of proprietary assets, mainly in the area of technology or differentiated products, or the economics of size that they get the economics of scale and scope. This ability to develop such assets and to acquire the capital that is necessary to grow them, they get it with um, defined environment with well codified laws that helps to sustain market exchanges and protect property rights and also by the sophisticated financial institutions. But when we talk about Chinese family firms, the firms start establishing from their own countries where the stable legal, regulatory, or institutional arrangements is absent. And in this environment, the protection of property law is minimum, and it's really difficult to raise capital through impersonal financial markets. So they normally fail to build a stable bureaucratic order. So they prefer interpersonal relationship rather than impersonal rules. And this interpersonal relationship and connections are typically acts as a substitute for reliable legal contracting financial structure. And of course, this such interpersonal relationship are as a basis for trust and a foundation for the development of family ownership. And this family ownership serves as a substitute for formal contracting and legal structure for the Canadian firms. Um, as we discussed about Chinese family firms in their establishment in their home countries, now when they are doing business in the other countries, uh, where the rule of law is more strong, more reliable, such as Hong Kong, uh, they don't normally forget the relational system they developed in China. In fact, these family values are at the core of their business. As a result, many Chinese family firms has developed a core competencies in relational or contracting. This is a competency that serves as a serves as its basic for ownership advantages. These Chinese family firms specialize in doing business in contexts where personal relationships and networks are important because a relational contracting implies the development of distinct networks of relationships that can be unique, firm specific, and difficult to replicate, And in this way, the source of success sustainable competitive advantage can be the interpersonal relationship. And in this way, the success of Chinese family farms is its ability to grow internationally is not the same as the ownership advantage as in classical M&Es, but they are quite a different, and their competitive advantage is related to the is not related to the traditional M&Es. Their competitive advantage is in the interpersonal relationship when they compete in the market where relational contracting is important. So thus these three propositions comes in. That these differences in ownership is reflected in different choices when the Chinese family firms strategize in planning scale, scope, and organizational structure. Uh, as we see in the first proposition, Chinese family firms are relatively less well presented in the industries normally associated with the classical M&Es. They compete in the market where the rational contract is important, right? Um, Chinese family firms also avoid activities where intellectual property rights are important, uh, like in the first, propositions 2, we see family firms are less R&D intensive and less advertising intensive than the average classical M&E. Um, in Chinese family farms, also you avoid industries where economics of scale and scope are important, because large scale production requires a large amount of capital, which in turn requires a reliance on capital markets. No, they don't have that, and as well as it's inevitably diluted for of family control, which they prefer. In addition to this, large scale production requires complex organizational structure, and that requires expertise that family doesn't possess because they don't believe in intellectual properties. So in this way, this third proposition comes in. Chinese family firms tend to be smaller than the classical M&Es, and ownership is more concentrated in this case. From our discussion, we are clear that Chinese family firms do not possess the ownership advantage that normal classical MNEs have, but Chinese family firms have different type of ownership advantage, that is interpersonal relationship, and they have the ability to do business in an environment where personal relationship, networks, negotiation, and deal making skills are very important, and this advantage of Chinese family firms is based less on the technical knowledge and intellectual property, but more on the ability to capitalize on the commercial opportunities and deals. And this type of opportunities you will find in the service industries mainly, particularly in real estate industries like development, shopping centers, hotels, construction, and financing. This way, the proposition 4 came in. Chinese family farms are relatively more highly presented in the service industries, particularly those partly related to the real estates and international trade, than in the classical M&E. As we discussed in the proposition 4, the Chinese family firms are interested in more service industries, but that doesn't mean that they are not found in other industries. They actually is involved in other industries, but that industries would be less industries technology intensive and would not involve branded products. For example, they can involve in light manufacturing and food production, also like manufacture of OEM goods for the branded products. In these cases, it will be difficult to identify any particular ownership advantage of the type of discussion we have earlier. The advantages might be strictly locational, relating to the factor prices and resources availability in the host countries, as well as the conditions of the home countries. Um, in this extent, that the old ownership advantages of the Chinese family farms are related to the home country conditions. For example, The Chinese family firm, how they're doing business in Taiwan and Thailand would be completely different. They normally develop a home-based competitive advantage that integrates the host country's context. So this skill of Chinese family firms allowed them to enter a new business, and often in these industries where government regulation is important, such as telecommunication as well. So in this way, this author have developed the proposition 5, that is the ownership advantage of Chinese family firms exhibit country effects reflecting the conditions in their home country. There are therefore both performance differences and differences in industrial distribution among Chinese family firms from different countries. The ownership advantage and ownership structure of the Chinese family firms are quite different than classical MNEs, and it reflects when they strategize and develop an organization structure, because they believe in interpersonal relationship will make the deal, but they are not based on any specific technology or brand. So they are less focused on the strategy that normal classical M&E would be. These Chinese family firms are more interested to keep their next generation involved in the firm, but in the classical M&E firms, they want to diversify into the areas that matches their interest or personal competencies, as opposed to those of the firm itself, because it's very important to um, get the different perspective as the owners of the firms. That's how the proposition 6 came in. Chinese family firms undertake relatively more unrelated activities than will the classical M&E, and other things will occur. The classical M&E normally establishes organizational structure that minimizes the problem of opportunism and a bounded rationality created by the presence of the firm-specific assets, and that reflects the firm strategy that firm has chosen. But in case of Chinese family firm, they like to establish organization structure that will maintain family position and control. This is how the authors have formulated the proposition number 7. Chinese family firms maintain simple and flat organization structure relative to that observed in the classical M&E. Reliance on outside experts and expatriates are minimized.
When it comes to the location decisions, the MNS location decision depends on a variety of economic and socio-political variables. It has to match the ownership advantage of the firms with the immobile resources of the host countries. They normally look for the largest market or the lowest cost supplier. It is kind of evident that many tend to avoid regions that are culturally different, and that can affect the choice of their entry mode and performance. According to electric parallelism, Chinese family firm also to some extent matches their location choices with its ownership advantages. They also look for the places, regions that are culturally similar and where they have clear advantage in relation to classical MNEs, and where a codified market enhancing institutions are weak and where personal connections are required. So, which is their strength basically. In such way, proposition 6 is developed. Chinese family firms tend to locate with their cultural and business network that is within Asia in general and specifically in China. Therefore, they are relatively less demographically diversified than the classical M&E. The type of ownership Chinese families have is quite unique and extremely difficult to imitate. And now for the Western M&Es, it's really difficult to acquire them, and also the language is a barrier. So when it comes to do a business in Asian environment, Chinese family firms has a significant advantage compared to classical M&Es. That's how the proposition 9 is. When Chinese family firms and Western M&Es compete directly in Asian market, Chinese market family firms are more profitable, other things equal. Chinese family firms operate not only in Asia but also in non-Asian market because they have a different advantage there. In Asian market, there is normally political and economical risk, and to reduce this risk, it's wise to move their business outside of Asia. It's normally the motive for investment is not only to utilize the farm specific asset abroad, but also to protect themselves from the risk involved in concentrating resources in Asia. So Chinese family farms accept a lower rate of return on their investment for the risk reduction achievement through diversification. That's how the proposition 10 is. When Chinese family farms compete directly against Western MNEs in non-Asian market, they are less profitable when other things are equal. The classical MNE have the tendency to exploit its ownership advantage abroad by minimizing the relevant transactional cost when, of course, other things are equal. Because since these advantages are largely based on farm-specific proprietary assets, market-based transfer methods like licensing are typically avoided. Um, Now, unless prohibited by law, the internalization transfer was accomplished mainly through a wholly or majority-owned subsidiaries. Recently, voluntary joint ventures have become more common as firms attempt to complement their ownership advantage or acquire new ones. But this is a different case in case of Chinese firms, Chinese family firms, because their ownership advantage is different, and their advantage of that their competencies of interpersonal relationship is extremely intangible and are not easily transferred abroad by market and contractual means. This is why Chinese family firm is expected to internalize ownership advantages. And this is how the proposition 11 is described. Chinese family firms attempt to internalize ownership advantage and consequently do not typically internationalize their operations through licensing or franchising models of entry. Chinese family firms have the need to internalize ownership advantage, and also then they have need to maintain family controls. Um, This is why it is expected that Chinese family firms will tend to move abroad by establishing wholly or majority-owned subsidiaries. And in Proposition 12, that is what is captured by the authors, Chinese family firms favor wholly owned or majority-owned subsidiaries when, of course, other things equal. In some circumstances, Chinese family firms may enter into joint ventures, but they may require to find Chinese partners, and that will actually increase their capability in certain ways. But when this joint ventures is operating mainly in Asia, Chinese family firms are very comfortable because there is a sense of same culture, network, and relationship. But when this joint venture operates outside of Asia, Chinese family firms may place greater weight on acquiring complementary capabilities because they are relatively weak in the area of technology. So we might expect them to find their partner in this area. So the proposition 13 is when entering a joint venture in Asia, Chinese family firm will choose as partners other Chinese family firms as well as firms and government institutions connected to it through Guanyi. And propositions 14, when entering a joint venture outside of Asia, Chinese family firms will tend to choose partners that augment its capability. Most non-Asian partners will be in high technology sector. To analyze the Chinese family firms as a multinational enterprises, authors have used data from the stock exchanges and the percentage of ownership of Chinese family firm in those stock exchanges. Also, they have analyzed the previous research papers that has been developed on the Chinese family firms. Analysis of this paper is built on the view that Chinese family firms gain competitive advantage by specializing in relational contracting and are able to leverage their skills into new markets where the institutional infrastructure to support the market exchange is weak. As this paper is based on the proposition, not the hypothesis, so it is beyond the scope of this paper to provide empirical evidence to support in these propositions, and it would be probably the necessary step for the future researchers like why Chinese family farms did not abandon the relational system even when they operate in business environment that didn't develop reliable legal systems and institutions such as Hong Kong or Singapore, or how they will respond as institutional infrastructure are strengthened in their countries like in China.
Canada and China have a strong history of economic connection. Though it started to rise in recent decades, but China started to invest in Canada from 1975 when the entrepreneurship immigration was first launched in Canada. And now China has become Canada's second most important national economic partner after United States. If when we see the China's investment contribution in Canadian GDP, we can see that China has a significant impact on Canadian GDP, employment, and overall economic activity. For example, in 2018, the direct GDP impact of China-related exports, new immigration, and Canada-bound investment was total 42.6 billion, 6.1 billion, and 9.4 billion respectively. But there is a overlap of these figures here, but the cumulative GDP effect of measurable China-related impacts likely exceeding 55 billion. So the Canada economic relationship between China and Canada is expected to grow because the complementary nature of these two economics, Canada's desire for stable investment destination and Canada's desire to diversify its trade relationship. We can expect a high degree of scrutiny for some transactions, especially the significant ones, but also expect transactional volume will grow.